Hey everyone, this is Dr. Tom Gerard, and I'm going to start talking about internal controls. This is our first video in a series of videos in this Accounting 1 module on internal controls. So let's take a look here really quick. In this first section, we're just going to talk about the purposes and principles. This may or may not be something that you thought you were going to study about in your Accounting 1 class. So we set policies and procedures in a company for multiple reasons. But internal controls now, we're talking about things that we're doing to maintain integrity of the accounting system, the accounting financial records. Because remember, why we're studying Financial Accounting 1 is because we're going to be preparing the financial statements, and we want them to be accurate. And so we're going to put policies and procedures to protect all of our assets. So assets, remember, it's cash, it's accounts receivable. Believe it or not, even though you think that this is not a physical thing, it is an asset that we need to protect our accounts receivable system. And we'll see that as we go on. We need reliable accounting. We have to uphold the policies of the company. So let's go on. Now, one of the things that you will study here in this course and other accounting courses to follow is the Sarbane Oxley Act. Now, I'm not going to go into a whole lot of depth in this, but this sets a lot of standards for internal controls. Now, the Sarbane Oxley Act only applies to publicly traded companies. So if it's a private organization, they still should be following all the internal controls that we're going to talk about. But by law, publicly traded companies, those companies that you can buy and sell on the stock exchange, are regulated by the Sarbane Oxley Act. And you can find a lot of information on this on the internet, and I might do additional videos specifically on this particular act. So right now, let's just move on to see what we need to do. So we're going to talk about principles common to all companies, or what all companies should be doing. Maybe even you're a small company, you're not a publicly traded company, but these are still good things to follow, and we're going to go through some of these. Establish responsibilities, accurate records. Let's talk about them individually. So first of all, clearly established tasks. So think about if you've ever worked in retail. Maybe you worked at a fast food place or something, or you worked at a Target or a Walmart or one of these any kind of retail store where you're operating a cash drawer. You're supposed to have different cash registers with different cash drawers for each person. In other words, if you're a small business and you have a register and you have 5 employees and everybody goes into the register drawer and is ringing customers up in the same cash register, then if money's missing or something's wrong, nobody really knows who took the money because everybody's in the same cash drawer, everybody's using the same cash register. So what happens is if you're at a big place like a Target or a Walmart or somewhere, everybody would get their own drawer, and then you're specifically operating that cash drawer. You're responsible for what's in that cash drawer and the money that's been taken in and the money that's going out and this kind of thing. And then if they say, well, open up another register, then that's going to be another person. They're going to log in and they're going to be able to take up in that particular register that's separate from yours. Okay, you don't want to just walk away and let somebody come over and take your drawer. So this is talking about one person having control over something at any one moment in time. Okay, adequate records. Obviously, we want to keep adequate records. At the end of your shift, if you're one of those register people, you're going to take your drawer, you're going to count your drawer out, and typically you would want, the company would want a supervisor or somebody to check to make sure that your records are all kept straight. Okay, managers monitor activity, detailed. Now, some of the things it's done, obviously, if you're using a cash register point of sale system, you're going to want separate, always POS system, it pays for itself. Point of sale system, if even small businesses, they can afford this nowadays. This is not something that's expensive. but it keeps track of everything. It keeps track of who's in there. You're going to log in. It's going to know that it's you. pre-numbered sales slips. In the old days, we would write a receipt. Somebody gives you money, you would handwrite a receipt. But even those receipt books were numbered. And so you might have your own receipt book and somebody else would have a different receipt book. And then that way we know that all these numbers from 1,000 to 2,000 is yours, and from, the 3,000s is this person's, and so on. Pre-printed forms. Use the chart of accounts. We talk so much about the chart of accounts. If you're an accountant, you talk to old-time accountants, they know that chart of account. They know those numbers. And by doing that, it keeps accurate records, of course. Now, this is a slide that talks about bonding people, insuring assets. Now, of course, we're insuring our assets. If you've got a multi-million-dollar piece of equipment, you're probably going to want to insure it. Even if you have vehicles, you insure them. You have all kinds of physical assets that you insure. But you can actually bond, what they call bond employees. It says bonded means the company has purchased an insurance against theft by that employee. So a bond is like I'm insuring a person, right? And typically your higher level people in companies are all bonded because they have a lot more power, more ability to go into the software systems. Maybe they're handling cash or dealing with assets. So we bond those people. I worked in the government, and the government typically requires higher level employees to all be bonded for these purposes, especially if you're working in accounting or the treasury and these types of things. So that's all that's talking about there. So separate record keeping from custody of assets. Now, we kind of talked about this a little bit when we were looking at the last chapter where we talked about inventory, and we talked about, even though we use a perpetual inventory system where it's checked in at the back room, it goes on the shelf and it goes out the register and the software keeps track of everything, we still want to make sure that it's physically accounted every so often. Again, those businesses like grocery stores that sell things quickly, they, you can't have bananas sitting around for 2 months. You got to have them sold probably within a couple of days, if not less. So you do inventory more often, but the person who's taken the actual physical account is not the person that has control in the software. Because if I have control in the software, and let's just say it's not bananas, but it's something that might be pretty valuable, I'm in a store and I'm taking records of cell phones. The latest cell phone is out, and we're selling cell phones, and I'm counting how many of these newest iPhones or Samsungs or whatever it is that are out, and I decide I want to stick one in my pocket, and then I also have control over the software system, and I'm taking the count, so I've counted up less and say there's supposed to be 10 and now there's only 9, and I have access to the software, the accounting software, where I can go in and I can actually physically, digitally change it from 10 to 9. So I have custody of asset, and I have control of the software that manages the financing, the financial part of that asset, the accounting system. So we don't want that to take place. So we always have 2 separate people, a person that does the count, a person that has control of the software. And then that way, if there's any discrepancies, they find out, what's going on. Why is there a difference? Reduces risk of theft or waste of an asset. And some people understand waste could mean, something got damaged or the person counted it twice or didn't count it, or didn't count correctly. Sometimes things happen that's not downright theft. But these are all kinds of things that you do to eliminate any possibility of wrongdoing. Divide responsibilities. Now, sounds like the same thing we talked about, but just think about now, if you're the person doing the billing, this is the accounts receivable, protecting my accounts receivable. I'm the person that's billing out customers, and customers might be coming in and paying, or I'm getting money in the mail by check or something of this nature. Many times it's people at the counter, small businesses, auto parts stores, things like this, places where people go in and purchase things and they pay cash, and maybe they're billed, right? So There's a commercial account maybe at the auto parts store because mechanics come in and they get parts and then you bill them at the end of the month. And then what happens is maybe this auto mechanic comes in and pays you cash and you're working at the place. So you give me cash and now I've billed you. So I am the billing person. And if I collect the cash for the bill and I'm also the billing person, I could actually take the cash and I can change the billing to say that, oh, that person really didn't owe for these things, or I gave them credit, or there was a discount, or whatever I want to say, to where I can, again, I'm able to manipulate the accounts receivable. So typically in billing, you have a person that's doing the billing, and then when somebody comes in to pay, that's a different person. And I know it sounds like if you're standing at the counter or something like this, that's a little harder to do. But imagine you're even taking, checks out of the mail. If you're a company, even think about electric companies or water companies. People are still sending in, a lot of people still send in checks, and you're the person taking the check. And a person that's doing the billing and the person that's taking the check, you want those to be two separate people. Because if I could fraudulently change the check to where, I can cash it, so to speak. And I've got a lot of stories on all these things that really happen. This is called separation of duties. And there's a big list. People that learn auditing, if you're going into accounting, a lot of times one of the first jobs you get is as an auditor. And because you really learn about a lot of this stuff. But auditors are trained to spot all of these things. Apply technology, right? Of course, we're using cash registers, point of sale systems. What about cameras? I always like these shows on TV where they say someone ran off and stole this from this store, and it looks like a video camera from 1955 or something. It's all grainy and you can't see anything. It's black and white. And I'm thinking, oh my gosh, a webcam, or these webcams nowadays you can get for $10 or $20, and it's 1080p. And I don't understand, when you have a place that you have money being transacted, there should be a camera on the drawer, a camera on the customer, and maybe even on the employees. I mean, cameras are cheap nowadays. This technology is very simple. You should always have cameras. How do you ever see a TV show or something on the news where a bank gets robbed and they don't even have a camera, or the camera is one that's, from 1975 or something? It's like ridiculous to me. But anyway, that's an electronic thing. If it's imagine a restaurant or a bar where there's a lot of cash coming across the counter at the bar. The bartender's pouring double drinks and pocketing some of the money. If this is your establishment and your business, that's stealing, okay? I know that many of you maybe don't think that is, but anytime you're taking something that belongs to your employer is theft, and including your time. And that's one of the things that we talk about in another slide here coming up. Apply technological controls. Auditors, preferably done, the auditors set up these technological controls because that's what they do, that's what they're familiar with, and how to set up these internal controls. And they're not involved in the activity. So if they think, hey, we need to start filming, we'll put a camera where the cash drawer is, then that's something that is necessary. And that's not it's not a bad idea. So technology, I think where I was going to talk about technology is payroll. And I don't know if we covered that here, but payroll, think about people clocking in on the clock. I think this is on here somewhere. Somebody's time clocking on the time clock, or maybe you're signing into the computer. A lot of people nowadays work from home, and so you're logging in. You have to be logged in when you're supposed to be working, and that's keeping track that you're not just logging in and then going to. I mean, I could tell you stories. Believe me, I've seen crazy stuff. People log in, they punch a time clock, and then they go out the back door and they go across the street to the bar, right? And anyway, I saw that one time where I was working. So you see all kinds of things happening. So this is, okay, limitations of internal control. Now, the interesting thing is auditors should also be bonded because, they actually learn a lot of the ways to steal things. And in my classroom that I normally teach in, I can tell you all kinds of stories that I saw when I was one of my first jobs in accounting was in auditing, and I saw all kinds of things. Human error. Now, sometimes, again, this is carelessness. It's just human error. It's not fraud. Over here, we see fraud. It's intentionally defeating internal controls for personal gain. Now, they're going to talk about the fraud triangle, and this is where I'm going to stop. Really, I want to cover this real quickly. This is a really good paradigm to look at, or a little, whatever you want to call this. Just, this is what happens, right? Somebody's under pressure. Now, again, in auditing, we saw this quite a bit. Believe it or not, auditors find, and I always like to use, the little old lady that works at the lunch counter at the school or the high school, and kids are buying their lunch or buying, chips and stuff, and the lady's collecting the cash. And what happens is the pressure comes, financial, emotional force. First of all, unless you're just independently wealthy people, at some point, everybody may experience some kind of financial pressure. Maybe you owe income taxes. Maybe somebody in your family's sick. A lot of times, the little old lady at the school counter is, grandpa is sick and he has to have some medical procedures, and she just doesn't have the money, and they're under this pressure. And it's not that this woman is a thief. She's not thinking like a criminal. Of course, a lot of people think like criminals, but this is like ordinary people that fall under financial pressure. And sometime in your life, you may experience financial pressure. And so what happens is you see an opportunity, and you see this opportunity like, oh, I could take some money out of the school cash register, and then I'm going to pay it back. I'm going to get my paycheck and I'll pay it back, or I'm going to borrow some money from somebody and I'll pay it back, or I'm waiting on this loan from the bank, but boy, I really got to I've got to pay my rent, or they're going to kick me out, or they're going to turn my lights off, and I'm trying to get a loan and I'm waiting for the money to come in, or I'm waiting for my paycheck. So I'll just take some money out of the till at the school or wherever it is that I can get this money from, pay the bill, get the electric company off my back, make sure I got electricity, and then when I get paid, I'll pay it back. So that's opportunity, and this is rationalization, is kind of what I'm saying. I'm going to pay it back. I'm not a criminal, but I'm just borrowing Peter to pay Paul, so to speak. But in fact, I'm borrowing somebody else's. Peter is somebody else. It's my employer, or it's somewhere where I have this opportunity. And so this is a good thing to think about, and you're always looking at things from this standpoint, is, who is it? If you see something that's missing or something's wrong, who has the opportunity? Who has pressure? And as we go through this in later videos, we could talk about change of lifestyle. You see somebody, and I could tell you stories of the computer. I'll just tell you a real quick one here. I know we're running into a longer video, but I worked in a place, and maybe you work somewhere where they have the IT people, the computer people, right? And so what happens is with the computer people, they come fix your computer, right? So, oh, my computer's not working, and they'll say, oh, well, we'll bring you a loaner because you've got to be doing your work. So we'll bring you a loaner out, and we'll take this one and we'll get it fixed. And so what these computer people do is you're seeing them all along. You see the guy in the elevator or going down the hall with a big cart full of computers or whatever. Nobody thinks anything of it, right? But while I was working, what he was doing is he was swapping out the computers, and then the ones he was taking out to his trunk. And who knows, a lot of, in fact, in our case, the place where they work on the computers is in a completely different building, a different department. And he's driving off with the computers, and nobody thinks anything of it because he's the computer guy, right? And so next thing you know, the guy's wearing some, Jordan tennis shoes, or he's got the new fancy styled hairdo, or he's got clothing that, like, oh my gosh, you had to be buying those at Neiman Marcus. How do you get that designer outfit? When you're just in my case, a government employee, you don't make that much money, even if you are the computer guy. So the lifestyle change. Oh my gosh, he's got a new Ferrari or something, And what he was doing is he's actually taking them out, the computers that he was taking them out, and he was selling them on eBay. And he had the side business. So, but nobody thought anything of it. Nobody ever paid any attention because that's his job, carrying out the computers. And so they finally caught him, and there was a way they did that. And it was the auditors that caught it, because everybody has a spending limit in the company, and he was taking stuff, and they found out that the numbers were off. They found it off in the software system. The software kicked it out, and we saw that these assets, the computers, were not being accounted for. And that's why you take a physical account of all of your assets, even if it's the computer that's on your desk and maybe you've used it for 5 years, it's still an asset of the company, and you keep track of that. Okay, we're going to have another video coming up. This one's been long enough, and so anyway, we'll see you next time.